we've assembled a broad spectrum of distinguished panelists who will share their observations and take questions regarding the current market activity in special purpose acquisition companies. The panel will address the dimensions of the current SPAC boom, make observations regarding the root causes of the rapid recent increase in activity, discuss the implications of the current level of activity, including potential issues which may be emerging, and may suggest some regulatory considerations intended to improve the SPAC market for investors. First, we'll be hearing from Dan Primack, who is a business editor at Axios and author of the daily Axios Pro Rata newsletter and host of the Axios Recap podcast. He covers the world of deal makers. The next speaker will be Jocelyn Arel, who's a partner in Goodwin Procter's technology companies practice and leads the firm's SPAC practice. Ms. Arel is recognized as a pioneer in the U.S. for her innovative work for clients on SPACs and has overseen nearly 2 decades worth of successful SPAC transactions. Jocelyn will be followed by Dana Settle, a founding partner venture capital firm Greycroft, for whom she heads the firm's West Coast office out of Los Angeles. Prior to her work at Greycroft, Ms. Settle had operating experience in industry as well as investment banking experience on Wall Street. Next will be Michael O'Donovan, who is a partner in the Strategic Advisory Group at PJT Partners based in New York. Prior to joining the advisory practice at PJT, Mr. O'Donovan had very extensive experience with a wide variety of transaction types in investment banking and private equity. And finally will be Michael Orogi, who is assistant professor of law at New York University School of Law. Mr. Orogi's research focuses on how legal deal structures impact the risks that corporations take and the positive or negative consequences these risks have on the public good. He is the co-author of the paper on SPACs that was circulated prior to this meeting with Michael Klausner of Stanford. Thank you again to each of our distinguished panelists for taking time out of your undoubtedly busy schedules to present to us today. Let's begin with Mr. Primack.
Chris, thank you very much. And thank you, everybody, and for calling us distinguished. I am clearly the least distinguished of the people who you're going to hear from today. But so I should begin by stating up front, it is a little unusual I'm here. I'm a reporter, not an investor. I've never formed a SPAC, invested in a SPAC, negotiated a deal related to a SPAC. The company I work for hasn't agreed to go public via SPAC, although at the rate things are going, that's probably just a matter of time. As you probably know, SPACs aren't new. The structure was kind of first created in the 1980s, really mostly by penny stock promoters. But the version we know today was created in the early 1990s, really for the same reason they're being created today, to help bring retail investors and help them invest in companies that would otherwise remain privately held. The term now is democratization of stocks. Back in the 1990s, it was just get more money for companies. It didn't really take in the early 90s, possibly because there was about to be this internet IPO boom enabled by small boutique investment banks. So the need for SPACs really never materialized. If you were a small or private tech company in 1996 and you couldn't go public, there was really, really something wrong with you. Instead, so what happened after that? They kind of popped up sporadically over the years, sometimes for property deals, but most notably kind of household names, Burger King and Hostess. But again, they were unusual. In 2016, only 13 SPACs were raised. That's 5 years ago. The number by 2019 rose to 59. Sorry, hearing feedback. And by last year, it hit 248. 248. So that's 4 years, from 13 to 248. And we're basically at that figure now for 2021, here on March 11th, with a pre-IPO pipeline of around another 200. There are more active SPACs today than SPACs have ever been raised in the history of SPACs in aggregate. So a couple questions. Why now? 3 major drivers. First is there's a ton of supply on the target side. Obviously, I assume you guys have probably heard the term unicorn, which is used to describe this privately held venture-backed company valued at $1 billion or more. They were called unicorns because they were incredibly rare, but there are hundreds of them now. New ones minted every day. I write a newsletter and things that a deals newsletter, and things that I would have in the past written about for days because they were so large barely get a mention at this point. In other words, what that means is You have lots of companies itching to hit the street, and SPACs are the fastest way for them to get there, arguably with the least scrutiny too. Number two, the capital markets are just kind of insane right now, and retail investors are kind of desperate to get into anything with growth potential. And again, we are often talking about younger venture-backed companies. There is more growth potential there. And third, SPACs are really good economic deals for the people creating SPACs. Lots of potential reward for relatively little work. Not no work, but compared to, for the folks who are normal venture capitalists or private equity or hedge fund managers, this is less work and arguably sometimes for more money. So the obvious question, are there warning signs? Is this a bubble? Yeah, but a quick caveat to that. I don't think SPACs present any sort of systemic threat because they're largely uncorrelated once the deals are completed. There's a little bit more relationship early in the process because you keep seeing the same names in the pipes, but a pullback would just mean deals don't get consummated and retail investors get their investment back, and the sponsors are the only ones who lose out a little bit, and sponsors are usually the ones who can afford to lose out a little bit. But for warnings, one, there's this rule. SPACs aren't supposed to talk with potential targets before completing their IPO. I don't know anyone in SPAC land who thinks such conversations don't happen and don't happen regularly. If for no other reason that you have often the same SPAC sponsor raises a family of SPACs. So if you've got your SPAC 2 in market and you talk with a couple companies about buying them, the ones you don't do, you might go back to and talk to for SPAC 3, but if SPAC 3 is not raised yet, that technically violates the rules. So I don't know if that's something the SEC ever seriously investigates or if they should, but it's definitely something that's out there. Two, press leaks on SPACs, and there are lots of those obviously, have more ability to impact the pricing of deals than do press leaks on traditional mergers and acquisitions. I love leaks. I'm a reporter. They're my lifeblood. I don't want them to stop. I encourage everyone to leak to me, particularly constantly. But it's worth noting, it is different when there's a leak related to widget company A buying widget company B than for when blank check company X buys something, because that latter deal, it determines everything that blank check company is. It's not additive or slightly changing their strategy. It's the whole strategy. And the unit prices move accordingly, even if a deal doesn't happen. And finally, retail investors will get hurt by the proliferation of SPACs to some extent. The SEC yesterday, I think, issued a warning about celebrity involvement in SPACs, saying, don't just buy this SPAC because Shaq is in it. But my guess is the people who need to hear that warning the most aren't the same ones who are reading SEC press releases. Happy to take questions later. Again, thank you very much for having me here.
Thank you, Dan. Jocelyn, over to you.
Great. Could we pull up my slides, please? I don't know if people can see them. I can't see them.
Not yet. They should be coming shortly.
Great.
There you go.
Great. Well, thank you, Christopher. And I sincerely appreciate the Commission and the Advisory Committee's invitation to speak here this afternoon and to share my 16 plus years of experience on SPAC transactions. I work on IPOs, the business combinations, and really importantly, guiding companies through the process of becoming a public company, because ultimately the SPAC transactions results in companies going public. If we can move to the next slide, please. Building on Dan's introduction, the rise in popularity of SPACs, this market didn't happen overnight. It's been building for years, as you can see through the trend line from 2016 to 2019. 2020 was already setting up to well surpass 2019. It had been something that we had been involved in for years, and we could see the additional numbers of investors really interested in broadening and joining the SPAC market. Things really changed from my perspective when COVID hit. We had a number of deals in the market, and I really think that COVID proved some of the things that we were saying all along, that well-structured SPAC transactions would close even in incredibly difficult and volatile markets. We'll talk a little bit about some of the attributes of SPACs, which are really attractive, but that was one of the core premises. And we saw that and transactions when we were seeing M&A and other transactions go by the wayside, the capital markets, other than SPAC formation, essentially frozen. We did see SPAC business combinations close on the terms that had been negotiated. From my perspective, that really propelled others to join in SPACs, and you saw the numbers for 2020, 248 transactions completed, IPO transactions completed in 2020 alone. Most of those happening in the last quarter, where growth really accelerated in the IPO market. That trend is continuing in 2021, as Dan mentioned. We're on track to hit those numbers that exceed 2020 growth in the first quarter alone. Next slide, please. We're also seeing growth in the business combinations as well, with sequential growth year over year, with 66 completed last year. Very few liquidations to date, but I do expect with the changing nature and complexion of the SPAC sponsors that we will see more liquidations as the SPAC market has matured. Warrant coverage has gone down, structures have changed, and some of the older SPACs have structures and have warrant coverage that far exceeds those of some of the newer SPACs. So I do expect to see some of those liquidation numbers to the right of the screen actually increase. Next slide, please. SPACs are also in every market vertical. As you can see, tech, life sciences, financial services really dominate the SPACs these days. If you looked back at this chart a couple of years ago, the biggest piece of the pie would have been the general or opportunistic SPAC bucket. If you go back and you read the S1s, it really talks about really being able to take advantage of any opportunities within the market. SPACs are now sponsored by a wide variety of participants, and those participants are focused on different industry verticals, and thus you're seeing each of those industry verticals really reflected in the SPAC IPOs and the focus of the SPACs themselves. Next slide, please. You're seeing the same happen on the business combinations, with life sciences, technology, and fintech really leading the way. I'd like to point out there's a specific advantage for life science companies. For life science companies, they can really combine what's called their crossover round that they typically undertake prior to an IPO, and they can consolidate the crossover round with their IPO in one transaction, arguably less dilutive than the two individually, and raise sufficient capital to really get through to that next value inflection point, results coming out, and not having to continuously be back in the capital market. So it really presents a significant advantage for life sciences companies, and thus the increase in life science companies using SPACs to go public, and the increase quarter over quarter in the number of life science investors starting their own SPACs. Next slide, please. SPACs aren't just a U.S. phenomenon anymore. In the last month, we saw the first Luxembourg-based SPAC list on the German markets. Last week alone, we saw the UK and Hong Kong make statements that they were going to be taking a serious look at U.S.-type SPACs. The U.S., we have seen, as evidenced on the prior charts, we have seen foreign companies come into the U.S. and use the U.S. SPAC structure. It's not appropriate for every company. Not all of them really have a nexus to the United States. So we're seeing other markets from a competitive and other landscape really focus in on the product. And so we really are seeing a worldwide expansion of the SPAC markets. SPACs are here to stay, and it's been a long time in coming. It's now is probably the first time in my career working with SPACs where conversations don't start out with companies or am I going to be tainted by going public with a SPAC? That's off the table these days, and SPACs are here to stay. They're a mainstream IPO alternative, and companies now have a choice in their journey to become public. They can pursue a traditional IPO, a direct listing, or a business combination with a SPAC. Next slide, please. Given the rise in SPACs, there isn't a day that goes by when there isn't media coverage on the different viewpoints of SPACs. As with any developing market, it has its champions and detractors. Having spent years in the market, I've seen the good, the bad, and the now. And from my perspective, though not perfect, SPACs provide several key advantages that are driving the market and exponentially increasing on a daily basis interest from every participant in the capital markets. If we can go to the next slide. Those key differentiators are the fact that the valuation is set up front. So the SPAC and the operating company agree on valuation. Doesn't stop there though. That valuation is validated by the SPAC's public investors as well as the PIPE market, who do a deep dive and significant diligence into the companies. There's greater transparency, flexible communication, and SPACs really are noted for their use of projections. In these transactions, the company, the SPAC sponsors, and the potential investors have a dialogue. There's much freer, more communication than you would see in a typical IPO. Investors are in the diligence room doing diligence on the company, and it's just a different process from what we are used to in a traditional IPO. The companies have the ability to really select the IPO investors. It starts with selecting a SPAC. Each SPAC has a different set of investors. We spend time diligencing those investors, and it allows the company to really start building longer-term investors who buy into the company's vision of who they want to be as a public company. When I talk about flexible communication, the communication really enables these companies to tell their story directly to the investors. It's not a scripted event for the company. We spend a lot of time at the front end really working with companies, helping them understand who they want to be as a public company, how they want to approach the markets, what type of information they want to be providing. And that's the dialogue that happens throughout this process. As I mentioned earlier at the beginning of my talk, there's reduced uncertainty compared to the traditional IPO path, in part because the valuation is set up front, and then we work to structure deals so that there's deal certainty and certainty of closure in capital. And so people are not caught in a position where there's market volatility and IPOs are put off or deals delayed or companies remain private. These deals also are typically structured with a PIPE. It allows companies to raise considerably greater capital in many instances than they could in a typical IPO process. It allows the company, once it's public, to really focus on the growth of the company and its objectives, as opposed to constantly having to be back in the public markets raising additional capital. This is, clearly an advantage that I've seen in the life sciences space particularly. And it has an incredibly flexible structure. We can take the structure and we can structure a tech IPO, a life science IPO, a PE IPO. Each of those has a different flavor, and the structure, because it's inherently flexible, allows us to structure deals in a variety of ways to meet business goals. If we can move to the next slide. We're also seeing the various trends in the SPAC market. As Dan mentioned, we're really seeing a shift in value creation from the private markets to the public markets. For the last 20 years, so much of the value has been built in the private markets and shared amongst a few. This is a much more democratic view of company building and wealth, and it enables investors to participate by investing in a SPAC sponsor. It's essentially a single purpose PE or VC fund. Average investors typically can't participate in a venture capital fund or a private equity fund. This enables investors at least with respect to one company, to be able to participate in that growth. And it allows them to participate in value creation earlier in the life cycle of the company. As you're seeing, a lot of these companies are pre-revenue, earlier companies that are coming to the public markets. And this allows investors to, participate in that public company growth. Next slide, please. One of the biggest myths, I would say, in SPACs, it's out there, it's in the media all the time. Dan just mentioned it, faster, cheaper, less regulation. I would beg to differ. We go through an IPO process to create the SPAC. We do a significant amount of due diligence on the investor deck before going out to pipe investors. A lot of thought goes into what goes into the diligence room that people have access to. The S-4 proxy statement has the same level of disclosure and the same scrutiny that we would go through in doing a traditional IPO. The only party who is not in those drafting sessions in every deal, and they are in some deals, are the banks. But SPAC counsel and company counsel work collaboratively, do the same level of backup, same level of scrutiny and review that we would do in a traditional public offering. I think it's just behind the scenes and something that's not really visible, given that it's really with the lawyers. And we spend an awful lot of time working with companies well before they start engaging with SPACs on making sure that they understand that they're going to be a public company, what the implications are, and that they're really set to be a public company when the transaction closes. So there is a lot more work up front. It's not that the SPAC and the company are getting together and deciding, from a dead stop, that we're going to approach the public markets. There's a significant amount of preparation that goes into this. Next slide, please. And there are, a few regulatory considerations that I would like to raise. SPACs are treated a little bit differently. They're lumped in with reverse mergers and blank check companies. Though the staff has done a terrific job in working with us, there still are circumstances where the financial statement requirements are greater in the context of a SPAC than they are in the context of a traditional IPO. There's a Super 8K required at the end to complete the DSPAC that's really redundant of the disclosure in the S-4 proxy statement. SPACs are tainted as ineligible issuers. They haven't done anything wrong. The companies have just gone public in a different way, and so they can't use the WKSI rules or free writing prospectuses for a 3-year period. Rule 144, which can really impact liquidity of the sponsors, the PIPE market participants, is not available for a year. There are limitations on incorporation by reference and a 60-day hold in terms of the ability to file an S8 that a traditional public offering would not have. So those are areas that I think are ripe for consideration. Thank you.
Thank you very much, Jocelyn. That was excellent. Dana Settle, you're up next. If we can get you, if you have slides, we'll get those in front of everyone.
I do not have slides, and now I feel really inadequate. So, nor am I as funny as Dan, which is why I'm probably behind the scenes more often. So I'll just, I'll speak to my own experience here, and I'll try not to be redundant because Jocelyn, that was incredibly comprehensive, and appreciate all that went into that, and really very accurate. So, as Michael mentioned, I co-founded my firm, Greycroft, about 15 years ago. I've worked in the venture industry for about 22 years and started out in investment banking. So I have kind of, seen multiple cycles. I've sort of been on both sides of the table. I've also been inside startup companies, and I've been involved with companies that have gone public and that have sold. So I've sort of been in each part. And then this year I did raise a SPAC. Together with a founder of one of my portfolio, or a founder that I've worked with on multiple companies. And interestingly, we sort of came at it not from the standpoint of let's go raise a SPAC, but rather from what we saw as a business opportunity. And we saw the SPAC as being the right vehicle for which to execute the strategy that we were looking at. And that is the strategy is actually building a new kind of holding company in the consumer products area, specifically focused on beauty, personal care, wellness. And it's been an idea that we've had for the last 3 years. And we had actually talked about, should we do this with private equity? Should we do this, with venture? Should we just try to do this, kind of building it organically? And to be honest, the SPAC is absolutely the right vehicle for it, because it provides us with the ability to go out and target multiple companies. By the way, many of these companies are founded by women, and actually bring them together in a way that we really couldn't do in any other structure. So, again, that's sort of enabling sort of new ideas to be brought forth to the public markets. Dan touched on this in terms of the sort of supply of companies, and I absolutely agree. There's massive supply of sort of public ready companies. And, frankly, when we started Greycroft, we started it with the idea that our companies would all exit via M&A, because at that time, the public markets were not available to smaller companies. And that has been a, phenomenon that has persisted for the last, really 15 years. And other than biotech, which again, Jocelyn, touched on, and that the access to public capital for biotech companies has enabled incredible innovation. And so if you look at just the disparity between, the private capital and public capital, it's like $4 trillion, globally of private equity, private capital, to $100 trillion globally of public capital. I mean, it's just, obviously not even on the same scale. And venture capital, which provides most of that kind of risk and access to sort of growth capital, is a small fraction of, the global private capital. So, it's sort of matching supply and demand. And I think what it's unlocking is innovation in terms of new technologies, innovation in terms of new company concepts. And frankly, one area that hasn't been touched on as much, which I think is really important, is with all of these companies, a huge number of new companies that will become public companies over the next several years as a result of SPACs, all have the opportunity to create new boards. And those boards can be filled by diverse board members. This is something that I hold near and dear to my heart, and I think is a really important point, because it takes a long time for boards to turn over in general. And as you all know, there's an increasing push to have diversity on boards, and I think this is a real opportunity to do so. So those are the sort of a few of the areas. I think in terms of where there's sort of a need to ensure the health of this market is aftermarket support and research. And as the investment banks consolidated and the division between equity research and investment banking has occurred, there is very little equity research, and I think that is something that does need to be solved. I think it's also an area of opportunity for sort of independent equity research firms to really develop and grow and support the aftermarket for these companies, and it's going to be needed. I think it does provide, again, I'm just trying to make sure that I'm not redundant with too much of what Jocelyn said, but the sort of transparency, opportunity for companies that are younger in their life cycle and still have significant growth ahead of them to get access to the public markets, but also for public market retail investors, again, a broader swath of investors to get access to growth, where, really these companies have been incredibly diligenced. And again, Jocelyn touched on it, but the due diligence that we're doing on the targets that we're talking to, I mean, I've been an investor for, 22 years. We're working with great law firms like Goodwin. We're working with, Credit Suisse, great investment banks, accounting firms. I mean, we are doing very deep diligence on these companies, arguably as much, if not more, than they'd be diligenced in going public via traditional IPO. So, I think that the opportunity here is real. There is no question that there's a significant volume of SPACs accessing the market, but I think they'll continue to grow so long as the supply of targets is there. Just looking at some of the other questions. I think in terms of sort of SPAC boards. So again, we sort of looked at what would be the right composition. Again, I'm just speaking to my own personal experience. I can't speak to every SPAC that's been raised. Obviously, Jocelyn and others have a lot more experience. But we really looked at what would be the need in terms of our diligencing our targets, and then in terms of what the board construction should be sort of post de-SPAC. And so there's actually been a fair amount of research done by McKinsey and others that having operators involved on the boards of SPACs, not just investors, and I say that as an investor, has been really critical to the performance of the SPACs post de-SPACing, and also to having real industry expertise and knowledge. And again, that's where for our SPAC, given the focus of it, I'm partnered with a really seasoned operator who has had multiple companies that she has operated and overseen. We have a public quality CFO who has worked in this industry, and we have a CMO who also has worked in this industry. So and have sort of surrounded ourselves with advisors that really know the company and the market space that we're going into. So again, I think like all public companies, not all SPACs are created equally, and I think it's really critical that there is significant diligence that goes into all aspects of it, and but assuming that's the case, which has certainly been our experience, I think that this will result in a large number of really terrific public companies.
Dana, thank you very much. Michael O'Donovan is next.
Problem with going, fourth is a lot of the good content's already been taken. So I'll try to hit some other areas. So I look at it, if I've taken hundreds of companies public through a traditional IPO process, and have been around SPACs, since their iteration kind of before the financial crisis, and obviously, been active in a lot of different ways with the recent wave of SPACs. And I agree with a lot of everything that's been said so far. As I look at it and try to think about the topics that would be most interesting for this group, I think a lot of it is, there's been efforts, right, to bring forth the ability for the broader public investor to invest in earlier stage companies, right? And there's been a lot of work done in trying to change the thresholds, right, given how long companies were staying private and how much of the accumulation of wealth was being in the private markets. And now what SPACs have done, I think, is brought that into the public markets. And I love the analogy that has been used around biotech, right? Because that's exactly the way I think about this. In biotech, it has been that way, right? You have companies that are going public in biotech. Nobody knows, right? I mean, they're very early. They haven't gotten very limited clinical data, haven't gotten to phase 3 yet, right? But they're going public, and they are getting public dollars in to advance that medicine. And I look at some of the companies that have gone public via SPAC, and I look at, are they all going to be home runs and be great companies? Nobody knows, right? The answer is probably no, but it's the same in a regular way IPO process. But what is it doing? You look at some of the companies that have been funded and would have had a hard time getting the the changes across a lot that's relevant to ESG, right? You look at the advancements that are being made in sustainability, whether that be in the electronic vehicle space, the hydrogen space, right? All these areas that are very capital intensive. And it's really hard for VCs to fund all of that build out, right? Because, you need large quantities of dollars and the funds just aren't big enough to do. So I think that it's really exciting to see these companies getting funded in the public markets. And I think that, the SPAC ability to go and to tell that story over the way that you can in a SPAC context is what is driving some of this. We spend a lot of our time with clients today really looking at it as there's 3 ways to go public now, right? And depending on a situation, each company is going to pick a different path, right? They can do a traditional IPO, the way that it's been done for the last 25 years that I've been kind of, doing IPOs. You can do a direct listing, or you can do a SPAC transaction. At the end of the day, you wind up a public company, right? You can look at it and say, a year hence from when you do that transaction, it kind of all looks the same, right? And the question is, what's the best way to get a given company into the public markets? And there's no cookie cutter answer for that, right? I think that there's a lot of debates at the board level as to which is the best way, and I think it really is situation dependent, right? As to what is the best path, and that's what we try to help clients understand. But I think the diversity in different ways to do it, I think is very exciting. I think getting more companies into the public markets, and a lot that many members on this call have done over the years, whether it being the Jobs Act and other things, right, and getting companies through the SEC process, right, with less less work, right. We want more public companies, and this is the way to this is a way that this is being achieved, and we're getting more companies into the public markets. I think from a diligence and disclosure side, again, I don't look at it from the legal side, but there's a question I think that was raised around the banks. Look, the banks we're doing diligence on these companies as well, right? If we're going to be raising a pipe for somebody, right, we have diligence processes as to the investment banks that they're going to need to do. Now, do we all know if the projections that are being put out on these companies are going to ultimately be what these companies look like? The answer is no, right? But no one knows exactly when robo-taxis are really going to become a real thing, right? I mean, just to use an example, right? But these are exciting companies, and I think people will understand what the risks are, and that these numbers don't mean that yes, they will hit these numbers. It's the best guesstimate as far as how things can be achieved over a longer period. Why now? Why has this become such a large component of the market after being a relatively small sliver of the market for so long? I think a lot has to do with there have been a lot of great companies that have stayed private for longer. I think the discussion around efficiencies of the IPO process and direct listings, I think it's helped the SPAC process to move forward. And I think that you kind of look at all those things, and the capital that's willing to fund some of these earlier stage companies in a private context is really what's driving it. Do I think we're going to continue to see issuance at this exact same pace as we have earlier this year? Probably not, right? I think I think we're at a very heightened pace, and I think that'll probably abate somewhat because I think the market will become over time, just as it is in any other form of capital raising, whether it be in private equity or venture capital, right? You're going to have firms and sponsors who perform really well, right, and have a really great track record, and it's going to be easier for them to do their second, third, fourth, 10th SPAC, whatever it may be. And for people who struggle and don't do good transactions, the first time around or second time around, it's going to be harder. So I think the market will get more discerning, just as it has when you think about capital allocators in private equity or venture capital. And I think that's what we're really seeing happen here in the SPAC world is people are building platforms, right? And I think that their name brand is going to be important. And I think as people, success is going to beget success, right? And the platforms that have had very successful SPACs are going to attract better quality companies, as you see, in other parts of the finance market.
Michael, thank you. That was very helpful. Our final panelist will be Michael O'Rourke from NYU. Michael, you're up.
Great, thank you. Could I have my slides loaded, please? I'll start while I'm waiting for them. So good afternoon. Thank you all for inviting me here to speak. Thank you to Christopher, the IAC, and the commissioners who are present. And I'll be presenting on some of the findings from my recent research on SPACs. And if anyone who is listening at home and wants more information, you can Google Sober Look at SPACs. You can find my full paper and more information on the topic. And the research I'll be presenting on covers all SPAC mergers that occurred between January of 2019 and June of 2020. Now, the past few months have seen a lot of new, I would say, exuberance in the SPAC markets. At this point, though, it's too soon to know how everything is going to play out with this most recent batch of companies that are going public through SPACs. So I'm going to focus my remarks on those for which we've been able to observe at least a moderate amount of post-merger history. I'll also be discussing some policy recommendations, and in particular, I want to point out a number of ways that current regulations are inadvertently giving SPACs advantages over IPOs and direct listings. And these discrepancies raise some concerns regarding investor protection. They also make it harder for IPOs and direct listings to innovate and compete with SPACs in ways that can ultimately help benefit both investors and companies raising money. Next slide, please. So the first thing to note about SPACs is that historically, post-merger returns to investors have been consistently and extremely poor. So for instance, for every year over the past decade that we have at least a full year of post-merger data available, SPACs have dramatically underperformed on average against an array of market indices. And this is a consistent finding. It's not just from my research. Essentially every comprehensive investigation into the long-term performance of SPACs has found this too. Now, for a while, this poor performance was somewhat of a mystery. My research with co-authors, though, shows that the poor performance of SPACs can likely be explained by the very high costs associated with using a SPAC to bring a company public. Overall, my co-authors and I find that SPAC costs are roughly twice or more those of IPOs, even accounting for claims that IPO underwriters underprice securities they sell. Now, some SPAC costs are obvious, like their underwriting fees or the sponsors promote, but there are other SPAC costs that have been poorly understood by investors and media commentators. So one example is SPAC warrants. And as I describe in more depth in my research paper, the SPAC warrants represent essentially free money that gets given away to IPO stage investors in a SPAC, and these investors almost uniformly sell or redeem their shares prior to the SPAC merger. So we find that buying SPAC IPO units, redeeming the shares, and either selling or holding the warrants gives an annualized 11.6 return with zero downside risk. Now, it would be nice if this money could just be magically generated. Who wouldn't like that? In reality, though, we find that this risk-free profit for IPO stage investors comes at the expense of SPACs post-merger investors. So another poorly understood aspect of SPAC costs is how redemptions amplify those costs. So for instance, consider just the sponsors promote. Next slide, please. So suppose a typical SPAC sells 80 shares in its IPO for $10 each and gives 20 shares for free to the sponsor as a promote. Now, initially, that SPAC will have $8 per share in cash, but if it experiences 50% redemptions, which is pretty typical looking at historical averages, it'll be down to $6.67 per share in cash. 75% redemptions, not uncommon. Historically, it'll be down to $5 of cash per share. Now, PIPE transactions at the time of the merger can help replace cash lost to redemption, but even given this, the median SPAC in the sample that I study only delivers about 71% of the cash that it raises in its IPO, and wherever there's a shortfall in that cash, without a reduction in SPAC costs that accommodate it, you're going to have an amplification of those costs. And the result of all of this is that even though a SPAC is selling shares to investors for $10 each at the time of its IPO, by the time it merges, it has much less than $10 in cash per share. Next slide, please. So we find, for instance, that the median SPAC has only around $6.40 in cash per share at the time of its merger, after accounting for all of its dilution and other costs. Now, given that dilution, you can ask, well, will the target company or will the SPAC investors bear those costs? Next slide, please. And the first thing to recognize here is that a SPAC merger is the functional equivalent of a company conducting an IPO and selling shares to new investors. So suppose a SPAC, our typical one, has $6.40 in pre-merger cash per share. Now, if the SPAC merger agreement gives SPAC investors shares that are worth at least $10 post-merger, then it's the target company that has borne the SPAC's costs. They've given up shares that are worth $10 each at least, but only received $6.40 in cash. Conversely, if the SPAC merger agreement gives SPAC investors shares that are worth $6.40 each, then it's the SPAC investors who bear those costs, and the target's owners get an even deal. A lot of the commentary on SPACs misses this point and thinks that no matter what happens, it's always the target company that's going to bear the costs, and really it's entirely determined by the details of the merger agreement. Now, this analysis suggests here that looking at post-merger SPAC share prices can give us some insight into who is actually bearing SPAC costs. Next slide, please. So these figures consider SPAC share prices 1 week and 6 months post-merger, and we plot them against pre-merger SPAC cash per share. And what we find is that post-merger share value very closely reflects the amount of cash in a SPAC before the merger. So in other words, even though almost all SPAC merger agreements stipulate that a SPAC shares are worth $10 each, our findings suggest that target companies are well aware that there is far less than $10 in cash behind those shares, and that target companies are negotiating deals that protect themselves from bearing the costs, or at least the full costs of the SPAC's cash shortfall. And this finding then drives home the importance of thinking about SPAC costs. So in our paper, we point out that the transactional advantages that companies find attractive about SPACs can also be incorporated into IPOs or direct listings and at lower cost. So for instance, if PIPE deals are valuable or if the involvement of a prominent sponsor to help attract investors is helpful, those elements can be included in an IPO or a direct listing, but without many of the factors like SPAC warrants that contribute to high SPAC costs. But in order for IPOs and direct listings to innovate and to compete with SPACs, they need a level regulatory playing field. And consistent regulations are also important to ensure that there are not gaps in investor protections for SPACs. Next slide, please. So this brings me to some of our regulatory recommendations. First, we note that SPACs currently enjoy an inadvertent loophole in the Private Securities Litigation Reform Act that enables them to more freely use projections than IPOs. And we recommend strongly that the SEC equalize treatment of projections for SPACs and IPOs. It's possible that SPAC projections may be facilitating investors believing overly optimistic target valuations and losing money as a result. We don't yet know that, though. At a minimum, though, we think it's essential that whatever the rule that the commission decides is relevant and appropriate for projections, it should apply evenly for SPACs, IPOs, and direct listings. Second, we recommend improved disclosure of SPAC costs and dilutions. So right now, on the front of every IPO prospectus, you can see the cash per share that the issuer will get, net of underwriting fees. And we think that SPACs should have something equivalent, showing cash per share after accounting for all of a SPAC's dilution and costs. And finally, we recommend that the SEC establish a unified framework for evaluating IPOs, direct listings, and SPACs, rather than, for instance, considering regulatory proposals and stock exchange rules for each path public separately. So to give an example, the NYSE recently brought a rule change proposal for direct listings that, among other things, would have given firms doing direct listings a grace period to meet minimum round lot holder requirements. After feedback from the SEC, the NYSE eventually dropped that grace period, and its proposal was then approved. So viewed in isolation, it might or might not have made sense for the NYSE to allow that grace period for direct listings, but a crucial piece of context is that SPACs already, in effect, enjoy it. And so what this means is that when evaluating a new proposal for direct listings, for instance, the commission should be very careful to avoid inadvertently creating preferences for SPACs or regulatory arbitrage opportunities and in general should move toward a comprehensive framework that seeks to harmonize rules for each path that a company can take public. In our one-page memo and in our full paper, we provide additional policy recommendations, and I would direct attention to those as well. Thank you so much.
Michael, thank you very much, and thank you to all of our panelists for very enlightening and helpful information. To start out our questioning, I'd just like to check first whether any of the commissioners listening have questions. All right, hearing none, please put them in the chat if you do, or just let us know. First question comes from Jennifer Marietta Westberg.
Thank you, Christopher. So I wanted to drill down a little bit more into the disclosure issue that was raised by Michael, but there may be other people on the panel that have other comments they'd like to give. So in discussing these fees, perhaps the fees are not as transparent as they should be. Can you provide a little bit more detail into why you think that may be the case? Or
yeah.
And then Jocelyn earlier said that she thought the regulation was really pretty up to speed with where she thought it needed to be. So maybe we could get both views.
Sure. And I will say, I have seen no evidence of people lying or actively deceiving in SPAC transactions, at least any more than happens in any other kind of capital market transaction. And in particular, when it comes to SPAC fees, very little, if anything, is completely impossible to find. The challenge is, though, it takes hours and hours and hours. So my study, we looked at 47 SPACs. It would take us 5, 10, sometimes 15 or more hours just to get all of the relevant information together in order to really compute how much cash a SPAC is actually going to have per share after accounting for all the little fees that it's paying. And some of them are not little, but all of the components of the fees that it's paying, after accounting for all of the discounts on shares that it's giving out or free securities it's giving out, alterations to those that get negotiated sometimes through multiple rounds of negotiations. We found that it can take there can be maybe 15, 20, 25 different places on regulatory filings, sometimes scattered across multiple different regulatory filings, that it's needed to really pull that information together. Now, if you have a sufficiently sophisticated investor who has a lot of trading, a lot of experience, and a lot of time, it is possible to get the information. But we think that investors could benefit if it were all put in one place at the very front of the filing, very standardized in how it's done, and in a more upfront manner.
And look, from my perspective, I have no issue being transparent on the fees, and I don't know of any of my SPAC sponsors that have any issues, or the companies. Frankly, it's an issue that we are laser focused on. And if you look at the conditions to closing to most of these deals, the cash conditions are usually on a net basis, net of redemptions and net of fees. To some of Michael's earlier points, if you look at the generation of SPACs, the 2020 vintage, 2021 vintage, I think it's really important to recognize that the economics have changed dramatically. The number of SPACs that have no warrants is increasing on a daily basis. The warrants also function as an additional capital raise, so it's not all free money. There's a cap on those warrants. There's an $11.50 exercise price. They're capped at $18, and that's additional cash to the balance sheet that companies do find extremely helpful. So there's a flip side, to that. To that piece as well. I do think disclosure across the board, whether it's, SPACs, direct listings, or IPOs, which are all by nature going to be different and have, different regulatory environments, that additional disclosure and good disclosure, crisp disclosure, not repetitive disclosure, is helpful across the market.
And I'll second that, the notion of SPAC evolution, I think, is something that I'm very hopeful about. And the fact that we are starting to see some zero warrant SPACs, I think, is a good thing. The challenge is that we're not seeing very many. So I looked recently about a week or so ago, and about 5% of SPACs currently looking for targets have zero warrants. Almost all of them are concentrated in biotech, which has sort of a unique group of investors that are actually buying into a SPAC IPO because they have an interest in holding long term. So it's good to see those developments. I hope we see a lot more, because I've been disappointed that we haven't seen more quick development in that regard.
And you will. I can tell you for certainty that you will be seeing more. And if you look at the warrant compression, just put aside the no warrant deals, look at the quarter warrant deals, look at the fifth of a warrant. I'm doing deals now with a tenth of a warrant. There's significant compression in terms of warrant coverage. The other piece, in terms of the sponsor promote, I think it's really important to recognize that though you do see some, the majority of SPACs have a uniform structure with a 20% sponsor promote, a lot of that promote is subject to, is negotiated in connection with the D-SPAC. It becomes subject to vesting, can have clawbacks in the event that there are redemptions. The last SPACs that I've done, so any of the SPACs that I've done in 2020 and 2021 to date, I've had redemptions of under 1% in all of those transactions. You're really seeing a transformation in the space, and frankly, I think some of the older statistics, are not going to be relevant in today's market.
Yeah, I'd second that, because I think one of the biggest changes we've seen, and I think this has led to the flywheel of more SPACs being issued, are the quality of companies, right, that will consider a SPAC transaction. I mean, we could ask Dana, right? I mean, if I was talking to anyone I know at a venture capital firm and I called them in 2019 and said, hey, you should sell one of your companies into a SPAC, the answer would be, but I have a great company, why would I do that, right? And I think that to me has been the biggest change in the market. The quality of companies that are now thinking about SPAC transactions, right? There's rumors out there of, companies such as, Grab, which is worth $40 billion doing a merger with a SPAC. That never would have happened in 2018 or 2019, right? They wouldn't have even contemplated it. So I think that to me has been the biggest change, has been the quality of the company, which then leads to fewer redemptions. And I think that, I spend a lot of time with the institutional investors who are buying the pipes of these transactions, and they fully understand the warrants, right, and what the potential dilution of the warrants are. There isn't a cash cost, right? Obviously, that there is a cost. We don't understand it, but it's the same as employee options as a cost, right? It's a cost when the stock performs, and so if the stock is trading below $10, yes, they may be able to get a price for that in the market, right, and get a return on it for the investor, right, because it's time value in an option. But that is an inherent cost, right, to the shareholder until there's dilution, from the stock actually performing and getting above the 11.50 strike price. So, I think there's a lot of moving pieces to all of this, which makes it an interesting and dynamic market for capital formation.
Michael, that's undoubtedly true, and I think Jocelyn would share your view that at the high end, we're seeing a stigma removed in very high-quality companies coming in at the high end of this market. But isn't it fair to observe that there's also some followers piling in here that are pulling the average quality back down?
I look at you could say the same in an IPO market, right? I guess that's why I just keep coming back to it's all about capital formation. I think that there's there's been a lot of companies, right, that well underperform in the IPO market as well. When you look at overall IPO statistics, right, and you break out the top quartile and the bottom quartile, right, there's huge differentiation amongst those. And I think that's ultimately what you're going to see in the SPAC market too, right? I think over the longer term, you're going to see these things have similar type of return profiles.
One thing I want to add is in terms of this question about good companies or bad companies, because I hear people say this a lot in the world of SPACs, and it always confuses me a little bit. As I see it, unless a company is a complete fraud, which I think very few are, any company can be a good company at the right price and can be a bad company at the wrong price. So Google's a great company. I'd be happy to buy its shares at its current price. I probably wouldn't buy them at twice the current price. You know, United Wholesale Mortgage recently went public through a SPAC, one of the biggest SPAC deals to go public. It's lost its investors a moderate amount of money so far. It doesn't mean it was a bad company. As far as I know, it was a good company. The question is, how are our capital market transactions structured in order to try to get the most accurate prices possible for the range of good companies we have out there?
Can I just point out that there is a distinction, though, and that what you do have, I think, with SPACs, and Michael, this goes to what you talked about in terms of the guidance. You hear a lot of companies that are going to go public via SPAC, and you say, why are you doing a SPAC instead of an IPO? They'll argue that because they are tech companies, particularly like electric vehicle companies, et cetera, that are pre-commercialization. So really are like what biotech companies going public are. They'll say, because we can't do an IPO, but a SPAC lets us do a lot more forward guidance than we can do for an IPO. So that's how we're going to do it. So whether they are good or bad companies, there is a cohort that is different sorts of companies for sure. And other Michael, just to go to the earlier point, I don't think it's that there's a lack of venture capital or private equity funding. I've never in my life seen more of it, including, you know, massive multi-billion-dollar private rounds. I don't think it's that. I think this is a chance to go into the public markets that they didn't have 2 years ago.
All right, our next question is going to come from Brian Helmer, and he'll be followed by Ted Daniels and then Rick Fleming. Brian, over to you.
Yeah, thank you. So I appreciated Dan's comments on that because it really it leads the conversation to where I want to go. And this is really a question for the group of folks who are involved in SPAC formation directly. A lot of the benefits that were cited during the various comments were generic benefits of bringing companies public, or were benefits to the companies coming public, things like that. The question I have is, what benefit to public investors do you believe the SPAC vehicle provides versus the traditional direct placement or IPO path? Just through the lens of the public investors, what is the benefit?
Yeah, I mean, I will comment on that as sort of we see it in our specific situation, where in the consumer products business, there have been a lot of things that have changed, really, pretty fundamentally, in terms of sort of selling directly to the consumer, data that goes into the process of developing products, marketing products, et cetera, clean supply chains and decreasing waste in the overall process of producing products. And those are things that the consumer is demanding. And those are things that are very difficult to layer onto existing companies, just given given all of their existing infrastructure. And so these are the companies that are growing very fast. So, the reality is that to get into high growth companies in this market space, you can't do it through any of the existing companies. They're not growing quickly. They have, a lot of embedded infrastructure that would have to be changed to enable that kind of growth. And so, in our specific situation, we see it as providing access to high growth companies, companies that the consumer, sort of millennial and Gen Z consumer are really demanding as they sort of look all the way through the products that they're using to see what are the ingredients, what is the supply chain, who are the people behind it, does it have a diverse management team, et cetera. So we see this as being providing access to public market investors for higher growth opportunities and to the kinds of companies that they actually want to be involved in.
And is the reason that the SPAC structure represents the way that those companies come public, the kind of companies that you believe investors want access to, does it relate to Dan's comment that they can make more forward projections? Is that part of it? Because I'm trying to understand what the benefit of it is, and why that benefit exists to the degree there is one.
Yeah, it's a good question. I think it's sort of a couple, sort of fewfold. And in this situation, we're actually putting 2 or 3 companies together to get to sort of that public scale, and also, as part of the platform that we believe should exist, where, it will be a holding company of multiple brands. But it is, so we are making forward-looking statements, and we are also describing in greater detail the changes that are happening in the industry. So it's about really being able to describe something, have a longer conversation with potential investors about it, and then really matching the investors, the PIPE investors, to the specific opportunity that they really, want to be involved with. So it's kind of being able to, it's twofold. It's being able to provide those projections, but also being able to really match, to the right investors and having those conversations directly.
And to layer on in terms of retail investors, an average retail investor can't buy a private equity fund. They can't buy into a venture capital fund. And when you have VC or PE sponsors forming these SPACs, you can actually buy the SPAC security.
But to me, so remember, the bottom line is these are companies private equity firms want to get rid of, right? We've seen a massive amount of capital come into that space. We've seen the private equity companies, to their credit, do the kind of mergers that we're hearing about in the context of using the SPAC. We've seen them trade companies back and forth to create different combinations and to create value and to provide growth opportunities. So again, that's a generic benefit that could be achieved in a lot of ways.
Well, let me just comment.
Public, you could just come public. So the question keeps coming back to, what is the benefit of a SPAC structure versus the traditional IPO framework, and why has that gotten so much more popular?
Well, again, I'll just comment specifically on my situation, but it's again, bringing 2 or 3 companies together and bringing them public, not wanting to do it with private equity, because frankly, with private equity, they're not focused on growth. And then you just have a clock ticking against you again. And that's not, for these companies that really want to build, inspiring companies for the next generation, they're not interested in having a clock sort of ticking against them again. They do want to be independent, standalone companies. And so, and again, that's sort of one specific situation where you're bringing up, 2 or 3 companies together. And that's why I said when we started ours, we saw the SPAC as the perfect vehicle for that. I think for others, like Dan mentioned, where there is the opportunity to really sort of tell that story to people who are interested and excited about the innovation economy and the opportunities that will exist, understanding that there is risk because some of these industries are very new, but where they, public retail investors and institutions who would like access to that. They don't want it to be closed off to just people like me.
That's we've got a couple of questions in the queue here. Let me just, before I jump to the next one, which will be Ted Daniels, and then we've got Rick Fleming and Sienna Sarah. Let me just jump on the back of Brian's question and direct it to Dan Primack. Dan, we've heard the phrase regulatory arbitrage batted around. If this isn't regulatory arbitrage, then what accounts for the explosive growth in SPACs in the last couple of years?
Part of the explosive growth is look historically at venture capital and private equity and hedge funds, to a certain extent, managers of them. There's a lot of sheep-like mentality. And you see this in the private markets. You're now seeing in the public markets, right? Well, all those venture capitalists and all those private equity folks have a SPAC. I should raise a SPAC. It's become a joke, right? If you don't have a SPAC, are you actually a private market investor at this point? So I think that's a sincere piece of it. And it gives a little bit of optionality. You're hearing venture capital firms talk about themselves now as full stack venture capitalists. We can back you out of the garage and we can bring you public and everything in between. So I think that's a big piece of it. And again, as I said in my opening statements, I think the incredible increase in number of well-funded, quasi-mature startups is playing a big role. And then I'll say finally, and this is kind of a political thing, but an SEC thing too, there's been a lot of talk over the past 5, 6, 7 years about how a lot of the gains, the investment gains in technology, have been limited to a small number of people, basically the venture capitalists who've been able to invest. You think of Amazon, for example, or take Google, raised like $35 million in venture capital and then goes public, right? There's a rival, somebody who's trying to create a new Google, and they just raised funding the other day. They raised more in their first round than Google raised in its life before going public. So you just have a lot more companies out there that are ready to go. And I think that's a very, very big piece of it. And again, as I said, on the democratization side, there is this interest in having more companies go public. The former commissioner of the SEC talked about that constantly, or the chairman of the commission talked about that constantly, right? We have too few public companies. Well, this is a way to get them to get more companies public faster.
That's helpful. Thank you. Ted, over to you.
Yes, just one question. I guess it's a spin-off of the question that Brian raised. But we're talking primarily about selling these securities to retail investors, or are we talking about in selling the investments to accredited investors? Jocelyn?
Yeah, it is a public offering, so anybody can buy the IPO securities and then they trade. So when the SPAC actually goes public, any market participant can